Hi, if you're new to my channel, I'm Tyra Banks. I'm a licensed agent and a certified licensing coach. And I want to share with you guys some of the things that I notice people miss on the basics section of the test. This includes vocabulary, but also a major timeline. So I'm going to start off, I'm going to read my notes, but I want to start off with when your coverage actually begins. So I notice this is a part that when I'm tutoring folks, they often get this wrong. I want you to think about the application being completed and signed as the first building block of coverage being issued. And so ask yourself the question when you're looking at your test and you see the scenario, ask yourself the question, was premium received at the time of application? So when you sat down with the client, they completed everything, they signed it. Did you collect a payment that day? Okay, if the answer is yes, then you're going to look and see, was the policy issued? So was the applicant able to receive coverage? If the answer is yes, then coverage starts at the date of application. All right, so I'll give you a real life example. This happened to a fellow agent. He sat down with a couple. I think it was on a Friday. He sat down with that couple and they paid their premium. Their application was received in the system. But again, this was a Friday, so it was a weekend. By Sunday, the wife drowned. It was a terrible accident, and she drowned. So she passed away. Now, remember, the company just received their application and their premium that Friday. Now, of course, the company had to go through its normal review process and underwriting. They recognized that it was an accident, nothing, no prior conditions, no fraud, nothing like that. And so they issued the policy. So that coverage, even though it had only been in place for a couple days, was paid out. Okay, because the premium was collected with the application, underwriting approved the application. So coverage actually started technically that Friday. So remember, if everything's completed and signed and payment with the premium, I'm sorry, the premium payment is received with the application, then coverage will begin at the date of application. All right, let's look at it if it was not paid. Let's say coverage was not, um, the premium was not paid when the person sought coverage. So they completed the application, but premium was not collected that day. Then you look at, was the policy issued? So when you're reading the scenario on the test, you want to read these details. You want to make sure that you're paying attention to them. Was premium collected? No. Was the policy issued? If the answer is yes, then you would collect the premium at the delivery of the policy. And so that's a premium that's due upon the delivery. You'd also have the client sign a statement of good health. And so oftentimes you'll see this in practice as being COD, cash on delivery. So you give them their policy, you collect their premium, they sign a statement of good health, and coverage begins that day. So coverage would begin the date of delivery. All right, so I noticed that timeline being one that's tricky for people. I also think that it's worth recapping the uses of life insurance. Remember, this could be different based on if it's personal use or business use. Let's talk about personal use. One major use is cash accumulation. If somebody's using something like universal life or whole life, they're maybe buying life insurance for the cash accumulation, for that cash value. Estate creation is the second one. So oftentimes people like myself, I have children, I want to take care of them should something happen to me. So life insurance creates an immediate estate. So memorize that. The next one is estate conservation. So let's say I've gone through all the trouble of buying real estate and I have assets. If I pass away, I don't want my family to have to liquidate or sell off my assets to be able to cover my funeral and my final expenses and pay off any debts. I would like my life insurance to do that. So it conserves the estate that I've built. It protects that estate. All right. So estate conservation is the next one. And then liquidity, because the money, the cash value money that grows inside of some life insurance policies is liquid. That means you can use it like cash. So when you're studying, you want to use your body, you want to use memory hooks to help keep things locked in. And so the cash value is liquid. You want to think about liquidity. Every time you say it, say that, say money. Okay, that means you can spend it, it's cash. You don't have to sell it off like a stock. A stock isn't liquid. You got to sell it in order to use the cash. A house is not liquid. It's an asset, but it's not liquid because you have to sell the house to use the cash. Okay. But the cash value that's in life insurance can be paid out to you in a check. It is used like cash. And then last, survivor protection. You want to make sure that if you're leaving behind um, children, dependents, that your survivors are protected from the loss of your income. All right. So we got cash accumulation, estate creation, estate conservation, liquidity, and survivor protection. That's the 5 personal uses. Now let's talk about business uses. One of the main ones that we see is key person insurance. Sometimes people get this part confused. So let's talk about it. If a business buys life insurance on a key person, the business is going to pay the premium on it. That key person represents someone who, if they passed away, there would be a loss to that company. So when I think about a chef at a 5-star restaurant, a CEO of a startup, somebody like that, where if we lost this key person, then the business would have to replace them. That costs money. The business may lose money because it loses credibility because that person was the face of it. So people may begin to wonder what's going to happen with the company after they're gone. And so that is a key person, and the business would be wise to pay for life insurance on that person. The business is also a beneficiary of that policy. So if I own a company, I hire a 5-star chef who's amazing and he's famous. The business has life insurance on that person's life. And when that person passes away, the business will collect the benefit check. All right. The other way that we see it is in business continuation agreements. This is buy sell agreements. And so the life insurance funds that buy sell agreement. Let's talk about how that works. Let's say I'm in a partnership and myself and my partner are equal in this business. We're both putting forth our assets and our time, and we're really growing the company. If I passed away tomorrow, that partner would need to buy my share of the business from my heirs. So a buy sell agreement is put in place, and life insurance funds the purchase. So that's buy sell funding. And then lastly, executive bonus. Oftentimes, when businesses are recruiting a high performing person, they want to make sure that they can sweeten the deal. So they will pay for that person's life insurance, the life insurance that that person chooses. They pay for that as a bonus on top of their salary. You don't want to think about that as key person insurance because with key person insurance, the business is the beneficiary. With executive bonus, think about it as an additional part of their salary where that person's family will receive the money should they pass away. All right. So if you guys have questions about any of this, let me know definitely in the comments. I'm also going to put together a boot camp. And so if you think of things that you know are giving you trouble and you want to see them happen in the boot camp, put them in the comments below or email me as you guys are always used to doing. So happy to be able to serve you in this way. And I'll see y'all soon.